Once you have found a good quality company at a reasonable price, should you buy it right away or wait? Is there a way to make this decision? How accurate can you expect to be on this? Is there a way to have the cake and eat it too? Just how important is this decision? When you find a quality company that is fair or undervalued, should you invest in it right away or wait? Maybe in the long term, either way, it will not make a difference. At least not much of a difference. However, we are all affected by what happens to the stock price once we buy a stock. If it falls, we get disappointed. Maybe even self-critical about our decision. It's natural and only seasoned investors can ignore it. But if there was a way to make an informed decision on this, it would help and you won't keep wondering about it. A sensible answer to this question can spur us to action when required and also prevent us from jumping headlong. So, is there a way to assess whether you should act right away or wait? Well, there is no way to do this that is 100% accurate. In the short term, the price of a stock depends on supply, that is, how many people are willing to sell at that price, and demand, that is, how many are willing to buy at that price. When supply is higher than demand on a particular day, the price falls and vice versa. Now, if this continues to happen in the subsequent days, we will see a downward trend in the stock price. Of course, it is seldom a case of a clear fall or rise day after day, every day. What we are interested in is the trend. A moving average of a certain number of days is useful to determine this. Averages over short periods are not very useful for investors as they are very erratic, since a single day price strongly affects the trend. As a long-term investor, you want a clear trend, a more definitive change. To make an informed decision on when to buy or sell, 50 and 200 day moving averages or DMA lines are useful for long-term investors. How do the 50 and the 200 DMA lines help take better decisions? The 200-day moving average line is a slowly changing line as it is the average of prices over 200 trading days or 40 weeks. The 50-day moving average is relatively faster moving as it is an average over 50 trading days or 10 weeks. The relative position of these two lines help us take better timing decisions, though they may not be right 100% of the time. And there is always a delay in getting a clear signal, and hence you can never catch the bottom when buying or sell at the peak. Anyway, it helps to remember that bottoms and peaks are all relative and over a period of time new ones are formed. When the 50-day moving average line crosses the 200-day from below, that is, when the prices in the more recent times are moving upwards faster than in the less recent times, the trend is likely to have become bullish and the prices are likely to rise. This is called the golden cross. Now, if you have a quality stock that is fair and undervalued, it is likely that the prices will rise and hence you should consider making your investments right away. If the 50-day moving average line crosses the 200 line from above, it is called the death cross. It indicates a turn to the bearish side and the prices are likely to fall. Here, you are better off waiting as you may get a better bargain. The trends shown by these two lines are more definitive than similarly drawn lines, but not always. In general, if the 50-day moving average is above the 200-day moving average, then the short term shows a rising price and the presence of momentum, and hence you're better off taking actions rather than waiting. Either way, it takes a few days of rising prices for the 50-day moving average line to move upwards and cross the 200-day line. Hence, by the time it does cross it, prices would have risen and you don't get the recent bottom. But having risen for a few days, the crossing of the 200-day moving line means it is a more robust movement and likely to stay for longer. At times, having found a stock that passes the quality and valuation gates, waiting for the golden cross to confirm the price rise can mean buying at a higher price. So, we have looked for a signal that comes in a little earlier but is still not very sensitive to a few days of price movement. We find that the relative movement of the current price and the 50-day moving average line provides a good aid to better decision making on timing. As you can see in the image on your screen, this trigger for the price trend changes happen before the golden cross and the death cross happens. So, if you have a stock that passes the quality gate and is undervalued or fair value, and you get a green light on the price trend, you are better off buying than waiting, as the price is likely to rise further. If it continues to rise, then it would hit the golden cross and you will be happy to see a strong upward movement in the price. Even if it does not, you have invested in a high quality stock at an attractive price. You are into long term investing and not momentum investing, which relies on investing in any stock that is moving upwards and is likely to do so in the near future, and then selling it when the momentum is over. To summarize, when the price trend is strong, the prices are likely to continue to move upwards, and hence it makes sense to act now rather than wait. However, if it is weak, you could wait for a better price. If the price trend is semi-strong, you could start buying, but consider buying in tranches. With this, we have completed how to identify a quality stock, assess whether it is fair or undervalued, and decide whether you should buy them now or wait for a better price. Now, in the next session, we will figure out how to build your portfolio. Thank you.